Hello everyone. So in today's class, we'll be working on the matching principle. Okay. So in the last class, we discussed the accrual-based accounting. Okay, where we see how item of revenue and expenses are treated. So for accrual-based accounting, we said for accrual, income are recognized and recorded when they are actually earned. But for expenses under accrual, we said expenses are recognized and recorded when they are actually incurred, regardless of cash payments. But for the matching principle today, we are going to look at two items of we look at expenses, revenue. Okay. So what this principle is saying that expenses should be matched with revenue they helps to generate. Okay, expenses should be recognized in the same accounting period as the related revenue. So what are the expenses that can be matched? We have cost like cost of goods sold. Okay, all these are expenses that can be matched. We have utilities. Okay, utilities, insurance, for example. We have salaries, we have rent. Okay, all these are expenses. Okay, salaries, we have rent, etc. So all these are expenses that can be matched with the revenue they generate. A company, they should match their expenses, okay, with the revenue that the expenses helps to generate for that year. Okay, so what am I saying? So let's say a company has let's say as at 2017 and 2018. Okay, so let's say the revenue the company generates, let us say assume is 20 million. Okay, $20 million. So the revenue is $20 million. So and it's in the policy of the company to pay a bonus of let's assume 10% of this. Okay, so 10% of 20 million, so that should be $2 million. So it's in the policy of the company to pay its staff 10% of what they make in 2017. Though let's say this payment will be made in 2018, let's say March 2018, this payment will be made. This bonus will be paid to his employees. So what the matching principle is saying now is that the expenses, okay, which is at 2 million, should be recognized on the income statement, okay, of on the 2017 income statement as 2 million. So we should recognize that expenses on the income statement of 2017. That's what matching principle is all about. So it's an accounting principle that dictates that companies should match their revenue with the expenses. Okay, the expenses with the revenue of what they generate for a particular year. That's all what matching principle is all about. For sales revenue, we have $20,000 in the month of February 2021. Cost of goods sold, this is an expense. That same month of February, that same particular year, and salary expenses, that same month of February. So how do we match expenses to the revenue it generates? That is matching principle. So first of all, I'll consider my revenue. Okay, my revenue. So let us say I have here my revenue in this case is $20,000. Okay, so let's look at my expenses. So here I have my expenses. The first item is cost of goods sold, is an expense. So let us say cost of goods sold. Okay, I have that to be $5,000, and the salary expenses. Okay, salary to be $3,000. So when I add this together, I have $8,000. Okay, so when I subtract this from revenue, I have my net income. So that should be $12,000. So this is the idea of matching principle. It's a principle that says you should match expenses to the revenue it helps to generate. Okay, thank you very much.